So, why would I get a call right now just as I'm about to go live? Is it Steve? We ain't heard from that guy in a little while. Non-farm payrolls. Interesting. Does call for a little bit of a well. Now, let's just break the logic down. Unemployment rate down. Non-farm payrolls coming in at 50K. So, not too bad. But the unemployment rate is down. What investors are focusing on right now is the concept of a soft landing being achieved, which means, in a nutshell, the Federal Reserve has been aggressive with its interest rate hikes, and they wanted to only increase the interest rates enough so that it can cool the economy or stop the economy from overheating, and of course, get it to a level where they can avoid a recession. This data that's just been released is solidifying that idea, which is why you're witnessing right now the Nasdaq moving up. But the problem that we've got is this. The labor market's come in showing that there's less people in employment, okay, or jobs being offered. But the unemployment rate itself has come in lower. So what gives? The main issue is the economy is still doing fine. But we are still to get news today, and that is from the Supreme Court regarding the tariffs. So we've had the one event, now we're going into the second event. Now they're saying that the information is going to be released today. Will it be today? Maybe, but it might be at the close, and they always like to do that over the weekend, don't they? So cryptocurrency still has the capacity to move in any direction. What we're going to do today is just break it all down because the market has not yet fully opened. And that's really important because whatever you're witnessing happening now could be a false move. If we actually consider what happened yesterday when we had the unemployment claims, they didn't react the way they should. It just moved ever so slightly up and down, and then it climbed a little bit, and then Nasdaq said, thank you very much, taxi, and then it slumped. What we're going to do is just break all down the logic that you need to understand today. Break all down the logic. What talk is this guy running with? Anyways, let's just break it all down. Mark, thank you very much for those memberships right there, bro. So some of you have now become Traders Reality members on the YouTube channel. So happy days for that. And what happened to your butler? My butler? He's all good. He's actually scooping up the snow so that I can, get out of my drive and drive. Let's break it down, man. Here we go. So the yields rise as jobs back rate cut. Caution. What does that mean? It says here, latest jobs reports reinforce Wall Street's bets that the Federal Reserve will move cautiously on cutting rates, keeping treasuries under pressure. Go over to it. Check this out. Going into the 2-year itself, you can see it's actually moved up, a big spike of volatility right there. Hit a high of 3.54. Going into the 5-year, do the same thing, 3.7. 10-year came in at 4.2. And then the 30-year spiked up towards 4.9. Unbelievable. Okay. Now, what is it that we need to be mindful of? Just look at the data. 4.4% on the unemployment rate, and then the non-farm change came in at 50K, less jobs, and average hourly earnings came in at 0.3%. So whoever's in work is getting the actual increase in the average hourly earnings. But look at the data that we've been getting this week. ADP came in showing that it's weak, all right? Not that many job offers. ISM services came in showing the economy has expanded. Wonderful. JOLTS job openings come in saying that there's less jobs being offered, but not as bad as what it was before, okay? It is a decent figure. Then, of course, unemployment claims came in at 208, suggesting the idea that things are good. And the only reading that has backed the idea of the unemployment rate coming down is, of course, the slowdown in the unemployment claims. The problem that the Federal Reserve has is this, which is why we've been going back and forth on the idea of data dependent. Look at this. Unemployment claims. Look at the data there. That looks pretty consistent, right? 199,000, 214, 224, 236, 191. That's pretty decent, okay? Now go and have a look at the non-farm. Look at the fluctuations. 64 plus, minus 105, 119, 22, 73. There is no consistency with the non-farm employment data, okay? None whatsoever. Is it seasonal? Well, what's causing this inconsistency on the data, which is why the Federal Reserve keeps on relying on the fact that it needs more data to justify whether or not they should be cutting. Now, on the street, it does say that the market is pricing in 50 basis point cuts this year. So that's 25 basis point cuts, totaling 50 basis point cuts going into the interest rates. Going over into the interest rates, we can see that there is near enough 100% chance that there is going to be a hold in the next FOMC meeting. Coming in at 95 spot, you can see that we are going to have our interest rates being held. Now let's just go and understand where we are with March. What are they showing? 69.1 holding the rates at 3.5, 3.75. Going over into April, we're having a look there and you can see it's still edging towards 3.5, 3.75. That's going into April. June, they're coming in on a little bit of a mixture. So up until June, this is where the bets start to change. But you've got to take into consideration that next week, we do have the CPI data. Now, is the CPI data going to be the full picture? Because we have had this government shutdown. Is it going to come and take that into consideration? Expectations are 2.7%, and then they're coming in at core CPI at 0.3. So they're expecting an increase on the core CPI. And that's the main metric that the Federal Reserve uses to understand the path that it's going to take with regards to interest rates. Going into price action to take it across the board, the euro, a wild price action. When I say wild, it took the Asian, went to the daily open, come back down, struck the Asian low, and it's come back into fair value in principle. Again, non-farm payrolls, and you can just see whenever there is no consistency in the data, the directive that assets take usually goes in a direction. So if the non-farm payrolls is good, that means it's good for the US dollar. The dollar goes up, the euro goes down, okay? But the problem that we've got is this. Good news is bad news and bad news is good news. Why? If the labor market is struggling, that's good news because it means that we're going to get rate cuts. If the labor market isn't struggling, that's bad news because it means we're not going to get rate cuts, okay? Sorry, we're going to get rate cuts. I've got that all mixed up. Let me start again. Flip, you know when you say the same thing over and over, you just lose your brain. Good news is bad news and bad news is good news. So if the labor market details are showing that there is weakness in the labor market, the Federal Reserve is more inclined to keep the interest rates or cut the interest rates, to actually stimulate the economy. If the labor market is good, it means that the Fed has no reason to cut the rates so they can then focus on inflation. We have that scenario. But we don't have the old scenario when data is bad, it means it's bad. When data is good, it means it's good, okay? That's why you're seeing this price action across the board. It's indecisive, okay? There's no clear consistency with the data. And when you don't have the clear consistency, that's when you get the Fed saying, we're going to wait for the data, we're going to wait for the data, okay? Now, quickly going over into other assets. So, dollar dominance making a claim to the upside. 98.8 came into play. I mean, we haven't had appreciation in the dollar in quite some time, and it'll be interesting to see the dollar continue its narrative to the upside, which will be helping the stock market. Going over to the NASDAQ, you can see that NASDAQ is now starting to pull back. It's usually the case. The first move is the false move, but I will give you guys a heads up. In terms of options on the QQQ, there is a very interesting zone at 620. This is a high call option zone, okay? And it all makes a difference on how price behaves at this point, because if they lose the 620, it means that the market itself in principle has already priced in the idea of rate cuts in this year. If they've priced it in, everything across the board might take a little bit of a tumble to the downside, but we don't know until the market fully opens. We are not going to know how everyone's expectation of the market is going to play out. Now, going over into the volume of the stock market itself, we go into yesterday's close and you can see the NASDAQ closed lower in the previous session. And then, of course, volume came in lower as well. This is not consistent with bull markets. It's not. You need follow-throughs, and especially when small caps start to outperform the big caps, that is a problem. Would you not want a bull market to be sustained by itself when you see the big names like Google, Amazon, the Mag 7, when all the big boys are declaring, big post gains in the day, you can justify that we are in a bit of a bull market. But when you're hearing about the Russell 2000 actually doing well and small caps are doing great, what the hell do you care about small caps for? With zero volume, not zero volume, but as I explained yesterday, it's all about rotation in the stock market. Investors want to just take on a little bit of risk and get out of it as soon as they can because Small caps are usually for short-term investments. Big caps are the companies where people believe that value is going to increase over time, so they're going to be more inclined to hold on to risk for longer periods of time. And we can see already that in regards to the bonds market itself, that the bonds represent, or the yields are representing that investors aren't really favoring the idea of the economy in the future being okay. Why? Because the yields are moving up. And if the yields start to move up, that tells you that investors' expectations of the future of rates are going to be higher, which means that the cost of business is going to be higher for longer, which means that companies like your your Nvidias and your Microsofts, they are all going to be subject to higher rates in the future. So when they do business, it's going to cost them more. That's not going to be good for the investor, because the more money it costs them, the less dividend it's going to give to investors. So investors will be inclined to rotate out of companies that are subject to changes in interest rates. Does that make sense? I hope it does. Going over into other assets, silver and gold, making a nice claim to the... Oh, wow. Japan's Takashi considers dissolving lower house. What on earth? You know what? There's manipulation here. Sorry. Japan lower house election likely in early or mid-February. Wow. Wow, wow, wow. That, do you know something? You're going to hear it from me first, right? I think they are going to do the carry unwind once we've hit extremes in Forex. They're going to do it, all right? Look, dollar yen is pumping up right now. And it's heading, dollar yen has to get to 160 for the Bank of Japan to do something. That is my belief. That is a Forex interventionary zone. All right. Forex intervention means that the Bank of Japan will be a purchaser of dollars, and then they will flood the market with dollars, convert to yen, bring the yen up, dollar down. Okay. Look what's going on. Look at the yen. Where are we at? The yen taking a nosedive. Oh, ladies and gentlemen, the carry trade unwind happens on extremities of foreign exchange. We are heading into extreme zones. Okay. I think that is monumental that they've done that. I really think that is monumental. I feel like they are manipulating Forex massively. And that's what Donald Trump's problem has been with Japan. Forex manipulation. That is a very interesting play on there. I'm going to do some more work on that to understand the basis of why are they dissolving the lower house. Why would you do that? Anyways, I'm not going to get into it, but Bitcoin, what have we got? The Bitcoin. This weekend, ladies and gentlemen, I'm going to be doing a session. What session is that, Tino? Well, for the Platinum members, you get access to the newly revised Masterclass sessions that are done on a whiteboard, okay? There's 28 sessions that I've done on the whiteboard. The newest session that I'm going to do is session 29, which is how to read spot bid offer on Bitcoin, Ethereum, and Solana, okay? Now, the chart that I'm making reference to is this thing right here. So I'm going to be doing a whiteboard session at helping the Platinum members who have access to the actual to the Masterclass sessions. I'm going to be doing a whiteboard session that's going to help them understand how to read this. That means talking about the rainfall chart, talking about the spot order book depth ratio, spot order book depth difference, and then correlating the futures to the spot order book and what the difference is between the two, okay? And then going even further into that and the rainfall of the futures and what have you. Rainfall effectively means that there is an influx of liquidity coming in or an influx of liquidity of being taken out of the book itself. And that's going to be done on the weekend. So if you want to take advantage of that, you become a member. It's pinned to the top of the chat. And you'll also get access to all of these other sessions where I talk about the depth of market, trading order flow, and all the various aspects of the hybrid. Go check that out. It does serve you, especially when you are using the hybrid system, because it's clear, concise, and the videos are roughly around 20 minutes long. In comparison to the old Masterclass sessions that were 2.5 hours long, you could actually complete all these sessions in one weekend, and you would be, in my opinion, very well informed about the hybrid system and, of course, macros in there as well. You'll learn about how to read macroeconomic data, similar to what we do here every day on the live streams, okay? Cool. Now, let's just break down exactly what we're seeing now. So, I'll give you a little bit of flavor. When I use this chart, I always like to consider where we are on the 12-hour or the 1 day, okay? The 1 day gives me a massive view of where we are with the spot buying, okay? And you can see, and that spot buying is coming all the way from August, going all the way through to the current date right now, okay? What is it that you can see, ladies and gentlemen? When you look at it, face value, what is it that you can identify from this? It looks like there has been more offerings than there has been bidding, okay? Now, the last or the highest bid or offer that came into play was when Bitcoin hit 97,000, and that was back in, November, okay? So that was the highest when Bitcoin hit 97, right? We go over to the highest point in Bitcoin at the time of August the 14th, 2025, and you can see that the highest amount that was sold was roughly, it was just under here, right there. At the highest point, yeah, they sold around 90, where is it, bids offer side, yeah, about 186 million in total. They sold Bitcoin as it was moving up, okay? So that's really important to understand that, okay? Because it's showing me there's more offers that have been selling Bitcoin, right? It appears now that we're going into a bidding cycle, all right? Because price action is reflecting that. Now, if you look at this zone over here, this is where price consolidates. This is where you get the clue about who's in control. You can see that there's been way more selling here. They've been selling Bitcoin, right? And the reason I understand it to be the case is because the bids are not as aggressive, or in terms of how many there are, right? There's more offers than there are bids. So then you're going to be asking the question, why is it when price forms a range, why does it break out to the upside or to the downside? That tells you why. It's not because of your little line that you drew that has been magically appeared out of nowhere. And you're like, well, this line here at 89,300 is the dog's B from back in the day when I was a little youth. I was still shitting Pampers, and Bitcoin just touched that line once and it did it again and again. It's my magical line. No, it's nothing to do with that. It's all to do with the participation of who's doing more of what in a zone. Answer that. Try and answer that question when you're trading. Who's doing more of what and it's not following through? You look at the chart and say to yourself, what have they been doing in this range? Have they been buying? Have they been selling? Look at this for a range, okay? You see this range here on Bitcoin? You'll be asking yourself, what are they doing more of? Are they buying? Are they selling? From a candlestick perspective, okay? Let me just remove all this stuff here. From a candlestick perspective, what can you identify about this, right? Look at the order flow. Forget your BS lines. Some people make money from it, then, mad love to them, but I need to add logic to what I'm doing, all right? Not visual logic per se, but when I look at something, I need to add a logic from within. Why do we trade depth of market? Why do we care about the footprint? Why do we care about order flow? Why do we care about it? Because the candlestick says, I'm a result of something. You as a trader have to say, well, what are you the result of? And when you try and answer that question, that's how you can align and prepare yourself for certain plays. So if you've got price action going sideways here, what are you witnessing? Oh, we got a rejection here. We got a rejection here. We got a rejection here. No, ladies and gentlemen, it's not a rejection. It's not a rejection. It looks like a rejection. But prior to these wick candles that are forming, what's up there? Participants that are prepared to sell, okay? So the book goes and attacks those areas. Quick grab, come down. Quick grab, come down. If these candlesticks finished positively, you would be of the assumption that everything's going to try and mark up. That means there is a high concentration of offers up here that are going to sustain the logic of price continuing higher, right? Because there's offers, they're planting themselves up there. But because they're not planting themselves up there and they are infrequent with it, The volatility of Bitcoin comes in and says, I'll take that order, bring it back down, because the order flow is suggestive that there's more bids below. So we're going to want to transact into those bids. Set the traders up with the belief that price action is going to break out to the upside because their flipping trend line broke out, okay? It's a line, but where's the context? I'm not saying you can't use it. I'm saying add context to it. I give you 2 lines at the start of every single week, ladies and gentlemen, and I talk about them all the bloody time. You know them to be the psychological high and the psychological low. What is it about the psychological high and the psychological low that you know? You know it's the start of the week. You know it's the first high and the first low that's formed at the start of a trading week in crypto. You also know that depending on what they do inside of this range, it's going to be reflective of how they behave throughout the rest of the week. It means that they could be coming back in to test that narrative and use it as an area of support. You want to identify an area of support? Here is your support here. So they came into play and showed interest. They came into it again and showed interest. Why at that point? Why would they go there? What happens at that point relatively to the range? When you add context to why you're taking trades, then you are eliminating the what could it do next? Bitcoin up, Bitcoin down. Okay? That's how you want to dissect the logic of the marketplace. All right? If you can't add logic, then how are you going to be prepared to react? If you don't see a reaction, that means you have zero permission to trade. Logic, reaction, permission. Start your days off like that. Have it on your trading view. You can write comments and share little pictures. Have logic, which is the hybrid. C for the reaction, and then permission. Have that on your charts so that when you do decide to take a trade, what's your logic? Hybrid system, order flow, anything. Okay? Price action going above the 50 EMA, below the 50 EMA, red candle, green candle formation, stopping volume candle, Brinks box, block trades, whatever you want, V shapes. What's the logic? What's the reaction? Is it from the block, the Brinks, the V shape, whatever it's from? Okay? What are you seeing price doing? Then you get your permission. All right? When you systemize your trading to a degree, or when you actually then put your thought process to have a system of thinking, then as long as you're using the right risk management, you can take a trade, and if it works, it works. If it doesn't, next trade. It's not going to break bank. All right? That's why people don't survive the game, because they put everything up front too quick. All right? They risk everything. They lose everything. Next system, next system, next system. That's why they hop. Traders, new traders, are rabbits. That's what they are. Because they're hopping from system to system to system until they end up sitting on the bull. In my opinion, right, the hybrid is the calf, grows into the bull. You're the calf. Whatever. Anyway, so you get the idea. So, the shit that rolls out of my mouth. Wow. Anyways, you get it. So, BlackRock. Is this, what's going on with the street? Why are they dumping everything all the time? So 3 minutes into the open, ladies and gentlemen, well, we got 3 more minutes until the market opens, okay? I just need to do this. Nasdaq. Nasdaq. What a guy. Tino, bro, what's the logic behind reducing rates in the US if it gets it, If I get it right, it devalues the dollar, right? Or wrong? If they reduce the interest rates, they are reducing the yield. It's not a devaluation of the dollar, but, well, fundamentally it is, but not necessarily. But, well, look, let me explain. When you buy Bitcoin, okay, you buy Bitcoin on the exchange of dollars, okay? So you devalue the currency when you change the denominating currency into another currency, all right? I want Bitcoin. Cool. Give me your dollars and I'll give you Bitcoin. Thank you very much. You've just devalued the dollar. You've now increased the value of Bitcoin. Wonderful. Now, I'm an interest rates investor, okay? I like to buy the interest rates. I want to speculate on the short-term overnight funding rate or whatever. I want to know where I'm at with the dollar. Right now on the US dollar itself, I go in and I can see I can pick myself 2 years. I can lock in 3.507% on a 2-year bond if I give the US government my money. Okay, cool. I then take my dollars and put them in that bond. Now, when I then see the market is going to have a reduction in interest rates, that means my yield is going to be lower in the future. So then I'm like, is it worth me actually now buying that bond to lock in a yield, which is going to be lower in the future? I'm not going to earn that much interest. I'll tell you what I'm going to do. I'm going to look at my dollar. Is my dollar worth actually holding if the yields on my dollar are going to be higher or lower in the future? All right. So I look at my dollar. My dollar right now is at 98.7. Okay. What does that tell me? It tells me that I don't have any appreciation on my dollar. So it doesn't make sense for me to go over into the bond market and put my US dollars to work so that I can then generate a return if the yields in the future are going to be lower. All right. Remember, Forex is about perceived value. What's the future going to look like? Right? Other dynamics that are coming into play with it. Interest rates are being held higher for longer. We know that to be the case. Where is it? So what am I going to do? Why would I hold on to euro right now? I'll tell you what I can do. I will go and exchange my euros because they're relatively strong-ish. Okay. Relatively strong. I'll convert them into dollars, get myself some dollars, take advantage of the short-term fact that we're going to have rates at 3.5, 3.75%, wait for the dollar to appreciate to a certain degree, and then when they do decide to cut the rates, I get rid of my dollars and then convert them back into euro, all right? Have more purchasing power on my dollar, but unless it gets above 100, there's no point. But let's make the assumption that it does. If my purchasing power of my dollar goes above 100, I can then take those dollars, revert back into the euro, because then that means there's going to be an expectation that the rates on the dollar are going to get cut. So I might as well just take advantage of it going up in value so that the future of purchasing power for me is going to be good. If the yield on the dollar is going to be higher for longer, that means it's going to cost businesses more money to actually borrow dollars. So I will then convert myself into dollars, get involved in that for a short period of time. Value of the dollar goes up. And then when it's time to cut again, get rid of your dollar, then convert it into stock, because the stock market would have priced in the idea of rates being higher for longer. They would have pulled back and then they cut the rates. The stock market goes back up again because money is cheap. That's the path of perception of value. Was that too much? I hope it wasn't. I'm going to create some shorts on YouTube to justify that. So gold is going to pump once the dollar yen hits 160, or did I mix things up? Don't mix up the idea of gold. Dollar yen and gold are good to trade together, okay? But you've got to understand, only trade gold against dollar dominance, okay? But trade gold relative to euro, pound, Aussie, okay? Trade gold relative to those assets. All right, because they're all paired against the US dollar. So as an overview of it, you want to focus on assets against the US dollar. All right, when you're trading gold. But gold now's expectation of the rates being held or cut, we go over to gold, you can see it is pumping up, but the dollar is pumping up too. So there's two factors coming into play right now. Gold is going up, safe haven, because the future might not look so great. Geopolitical interest might not look so great. Dollar is going up and gold's going up. Both do not generate a yield. Dollar does, gold doesn't, because it's zero yielding. Okay. Gold's going up geopolitically. It's not going up for the interest rate cuts. Okay. In other words, what's going to dominate? It's going to be dollar, because there's more dollars than there is gold. In my opinion, this move to the upside on gold is going to be short-winded. We're going to be getting ready for the next hedge. That's my logic. Anyways. Tino, Nikki is up 3% today. Any reason? The reason is because there is a lot of investment going into Japanese companies. They are slowly but surely preparing for interest rate increases in Japan. They are going to do it. And you know what we've got this month, ladies and gentlemen? Before the FOMC, we have our Bank of Japan press conference coming out on the 23rd of January, and then FOMC comes out on the 28th. So that is going to be an interesting one. That should make sense. Bitcoin, what are you doing? Bitcoin, what are you doing? Are you breaking down? NASDAQ, what are you doing? You're breaking down. You're breaking down, NASDAQ. Don't tell me you've lost it. Oh, we're at the 620, man. This is important. This is going to decide whether or not the dealers on zero DTE options, okay, 0 day till expiry options, are going to get triggered with excitement or not. Because if they lose this 620 call wall, dustbin. Why? Because we have a wonderful dustbin down here, which is a gap on the QQQ. Will it take it? I mean, yesterday's low could be logical, but all the way down there, that would be frightening. Oil. Venezuela. That's exactly what that is. Look, they've done the V-shape reversal. Venezuela. The Venezuela energy reversal. Okay. What an absolute joke that is. And they're getting concerned about Donald Trump trying to take over businesses, man. Where is it? It did say that, well, hold on. Oh, we got some news. Hold on. Kramer's talking. Hold on. China, Russia, and Iran send ships to South Africa ahead of naval drills. Do not, that could be it. That could be the reason why gold could be moving up. China, Russia, and Iran send ships to South Africa ahead of naval drills. Don't do it, all right? Don't BS me and tell me that this is just a naval drill. Trump's just increased his defense spending to nearly $1 trillion annually. We're just going to practice. We're just going to see if we can sail across, the coast and just see if our ships work. What the hell is going on? Ladies and gentlemen, God, it wouldn't be a financial market if there wasn't a war. You've just increased your expenditure on defense. That's just a sign for what? Let's get ready to rumble. It has to be. Anyways, oil is pumping. Bitcoin is slumping. Solana is slumping. Ethereum has gone to bed. In other volatile assets, the dollar dominance itself for USDT is starting to make a little bit of a climb. Do you remember the time when I said to you when it comes back into a psychological area of interest? We're at that point. What happens if the tariffs get cut and inflation cools, but then the carry trade unwinds? If the tariffs get cut, the US dollar itself, all right, GDP, okay? It costs, for every dollar the US earns, they owe 126% on that. The tariffs have been reducing that deficit, okay? If they have to pay everything back on the tariffs, you're just putting the US back into a situation that it doesn't want to be in anyway. All right, how many of you in this live stream? Okay. Bitcoin pumping today, Tino? Let's hope so. Haven't said anything about XRP, though. I won't. Okay, then. Can you cover silver, mate? I can cover silver. Just talk about gold. Well, not quite, Frank, talk about silver, gold. But anyways, listen. So the spot contracts on the actual commitment of traders report for gold and silver says that they are heavily short, okay? And they are more than likely adding to that position. But there is a little bit of a squeeze coming into play because if they are short on positions on silver and gold, then they will then take advantage of a gamma negative play in principle and start going long on spot so that they can hedge themselves, build up more stops or short positions on gold and silver because of the anticipation of rates maybe being held for a certain period of time, and then price will effectively then roll back down again, okay? Bitcoin Bill, mad love for those Traders Reality gifts. Thank you very much. Giving back to the community. And other than that, please go back to the old MT4 streams now, man, because it takes forever to draw an MT4. It absolutely does. But yeah, my expectation is I'm net short on silver just for a short period of time until we know where we are with the rate cuts. That's exactly what I am with silver, ladies and gentlemen. Oh, NASDAQ, look at that reversal right there. That wonderful, wonderful reversal, that treachery. Look at how dog shit NASDAQ is to people. It's so bad. But anyways, that's the market for you, ladies and gentlemen. So with that being said, I hope you've enjoyed that. Hit the like, subscribe, and all that fun and games. Live's gone too long, but I'll be posting something for you all later on. Have a great weekend, guys, and check out the Traders Reality website for the new session that's going to be released tomorrow on Saturday, session 29 on the spot order depth chart. All right. Take care of yourselves, gang. Mad love and respect. Peace.